In tonight's squeeze play, has America gone from being a winner to being a loser? How would you rate the United States as a credit risk? Well, Moody's actually has awarded the U.S. with a AAA rating since 1917. But today came word that Moody's is thinking of lowering that rate for the first time ever. Could U.S. Treasury bonds soon rate as junk bonds? Here with us to discuss this is Steve Forbes of Forbes on Fox, among other things. Peter Schiff, author of Crash Proof, and no, that's George Gilder, author of about 150 books and chairman of Gilder Kremers Fund. And we're going to start with Steve Forbes because this article really sort of jumped out at me. It was on the cover of Financial Times, where we heard that Moody's, which hasn't been rating all that well, they rated a lot of subprime debt pretty poorly, but they are thinking of...
It could be a sign of the bottom.
It could be a sign of the bottom, right? But is it conceivable that what they say about the United States is correct, that we may deserve a lower rating as a country?
Well, we certainly deserve a junk bond rating in the way the government has treated the dollar. No great country should have a junk currency, and the policy of the Treasury Department, wink and nod, has been to lower the value of the dollar on the mistaken theory that strengthens the economy by boosting exports. But you see, on the housing side and elsewhere, it creates huge distortions within the economy. No president since Jimmy Carter has trashed the dollar as much as this administration. And what they should do is shore up the dollar, forget about pegging interest rates, soak up some of the excess liquidity, defend the dollar, and by golly, you'll see the equity markets rally.
Of course, we just heard our guest before talking about how what we need are more rate cuts right now.
Forget the Fed trying to manipulate interest rates. What the Fed should do is preserve the integrity of the dollar. Same with the Treasury Department. If it does that, the markets will rally and short-term interest rates will come down on their own because the dollar won't be going down in value.
Now, interestingly, the Financial Times and Moody's didn't talk at all about the dollar. What they were concerned about was the amount of money that we're spending in our federal budget, the U.S. government budget.
By that standard, it's preposterous. The 1970s were much worse than what we have today.
As a percentage of GDP.
Then the budget deficit is far lower than it has
been in the past. But Steve, let me just throw some numbers out because they're kind of shocking when you think of how much we're spending. In 2007, we spent a total of $2.7 trillion. $2.7 trillion on our federal budget.
Consistent about 20-21% of the GDP for a long time. That's what doesn't worry me. What worries me is what they're doing to the tax code. That's what worries me.
Keep that graphic up if we can. The 56% part of that pie is Medicaid, Medicare, and Social Security. And those are the issues that concern Moody's most, shouldn't they?
Well, yes, and the way you do that is not by their solution, another solution of raising the retirement age to 120 and throwing people in the gutter on Medicaid and Medicare and raising taxes. The way to do it is to allow young people to have their own personal retirement accounts. That's the way you save Social Security. And on Medicare, Medicaid, and health care in general, let the consumer have more control over health care dollars through things like health savings accounts and allowing you to buy health insurance around the country instead of in one particular state.
But you're not concerned about the size of the federal government right now?
The size is what it is, and sadly no one's made an effort to reduce it. But what I want is a fundamental reform of Social Security and health care. I don't want the root canal austerity approach that the Democrats have and certain Republicans have.
George Gilder, I see you shaking your head no when you say concerned about the size of the federal government.
I'm not vaguely concerned about the size of the federal government. It's what it is, and what I understand is that what we do today is almost totally irrelevant to supporting old people with medical care and food and housing in 2025 or 2050. The world's going to be completely different 20 years from now. The idea of us in the middle of a war and a crisis worrying about Social Security is just perverse.
Well, has America become a second-rate power?
No, we have 5% of world population, about a quarter of world GDP, and about close to half of world market cap. The idea that we're somehow a victim of the global economy is obscene.
Well, I think Peter Schiff is saying exactly that, aren't you, Peter?
Well, first of all, when it comes to, sovereign debt, it's not the default risk that they look at so much. It's the foreign exchange risk. It's the risk that you loan money and you get paid back in depreciated currency. And certainly the dollar has no place to go but down. Ben Bernanke's made it clear he couldn't give a darn about the value of the dollar. He should be raising rates, not cutting them. But if you look at the problem we have with subprime, right, the biggest subprime borrower of them all is the federal government. And we've done the same thing as individuals. We have an adjustable rate mortgage on our national debt. The national debt now, which is approaching $10 trillion, is financed with Treasury bills. We used to have it financed with 30-year government bonds. But in order to save money in the short run, just like homeowners did, we refinanced that into T-bills. The problem is going to really come when short-term interest rates spike up. What happens if short-term rates go to 10 or 20% like they did in 1980, and all of a sudden we have to pay $2 trillion a year in interest on the debt, and it's held mainly by foreigners?
Well, what does happen then?
Well, we default. Either we print money and pay it off like Weimar Republic
Let me ask
Germany.
Steve, has it come down to the point where we might actually default, and in that case, Moody's recommendation might be accurate?
No, there'll never be a formal default. You'll just get back depreciated dollars.
What's the difference?
Well, the difference is you can preserve the integrity of the dollar through open market operations, sell bonds and reduce the money supply. It's very simple.
They can't do that, Steve.
Why not?
If we have a $2 trillion external drain, if we have to print up $2 trillion,
you're assuming we get 20% interest rates.
Well,
you only get 20% interest rates if you're printing globs of money. If you preserve the integrity of your currency, as Volcker showed, guess what? Interest rates come down.
We've got inflation right now already as high as anything we had in the 1970s. It's going to get a lot worse. The price of gold has tripled in the last 6 or 7 years. It's going up every day. The dollar's about to fall through the floor.
But you're making it sound like this is like the weather. We can control the value of the dollar.
How are we going to do that? How are we going to control it? Are we going to raise interest rates several hundred basis
points? Didn't Paul Volcker control it by cutting off the amount of cash that was circulating?
Yeah, but remember,
history shows when you preserve the integrity of your currency, interest rates come down.
Steve,
and the way you do it is you take a bond, sell it, reduce the excess liquidity, and voila, people want to hold your currency again.
Steve, who's going to buy it? We can't do that anymore. We have a negative savings rate. We have a huge current account deficit.
Negative savings rate is nonsense. We have half the world's savings.
No, we don't. How can we have a $65 billion a month trade deficit? We don't have any savings. That's the problem.
Trade numbers mean nothing, Peter.
Sure,
We've had 300, 400, last 400 years, America's had trade deficits of 350.
Hey, guys, I'm going to cut off this conversation for just a second, because one thing I want to focus on with George Gilder is the notion that the United States still continues to be the cradle of entrepreneurial activity. That is, this is the country that has a right combination of political and economic freedom to create entrepreneurs like no other country in the world, no matter what Moody's says, right?
Yeah, I just came from an advanced equities conference in California where innovation is greater than I've ever seen it in my lifetime.
And you've written a number of books on innovation and the chips.
And then I went to Needham Conference in New York, 500 companies, mostly public companies, with more powerful, innovative stories than I've ever heard before. This country is effervescent with creativity. They are companies that act globally around the world, and the crucial danger to them is the possibility of xenophobia, resistance to high-skilled immation, and protectionism. That's the threat to the U.S.
So Peter Schiff, look, I know how pessimistic you are about the dollar, the value of the currency, et cetera, and I think a lot of us would agree with you that it has been debased unnecessarily in the past number of years, but still, there is something different about the United States that creates this spirit of enterprise that you don't find anywhere else.
No, that's not true. There used to be something different about us. It doesn't exist anymore. You know, Steve, when you talked about us borrowing money, a deficit for 400 years, you're wrong. When we were first starting out as a nation, we did borrow money from wealthier nations to invest, to build factories, to build infrastructure. That's how you get rich. You borrow to invest. But what we've been doing recently is we've been blowing money. We've been borrowing to consume. We've dissipated dissipated wealth. We've spent ourselves into poverty. No, we're not the low tax, low regulation country we used to be.
Hold on, Peter. Go ahead, Steve.
Last I looked, at the end of the third quarter, consumers in this country had financial assets net of $30 trillion.
No, we're broke,
Throw in
Steve.
housing, $50 trillion.
Steve, we
if
can't
$50 trillion
afford to pay the
of net assets is going broke, give me more of it.
And George
Steve,
Gilder, the fact is that there are a lot of people working in their basements, working with companies that are still inventing things that eventually will come on the market and people will buy them, correct?
Hold on. That's right. And that's what will determine whether we can supply the baby boomers with health care 20 years from now. It's the utter transformation of the U.S. economy and the global economy during that period. Tens of trillions of dollars, new wealth, tens of trillions of dollars all around the world will be generated. What will determine whether this money ends up in the United States is whether we have low tax rates, freedom,
Peter, you know what you're doing, you're making a fatal mistake, I think, Peter, in my humble opinion. Hold on a second. What you're doing is mistaking wealth for riches. You're right. Some of our riches have depleted because we got off the gold standard, a lot of other things, but we still have wealth, which is the capacity to create something new. We have that spirit. We haven't lost it, Peter.
No. Well, how come, you can go back. I've been coming on these shows for 3 or 4 or 5 years. Every single prediction I've made about the dollar, about commodities, about oil, about housing, about mortgages, everything I've said has pretty much panned out the way I've said it. I don't think I'm mistaken on anything.
And
I think I have this whole situation
George
nailed.
Gilder has written books about how the microchip would progress in ways which turned out to be exactly true.
It's got nothing to do with the economic fundamentals or the rotten
It
shape
has to do with our country, and there is something
but he hasn't been right on these markets.
There is something intangible about the way this country works, a combination of freedom, economic liberty that creates wealth and creates enterprise, even though, as you're right, some of our riches may be drawn down at different points.
No, we are in serious shape. If our economy was in good shape, the dollar would be rising. It wouldn't be falling.
All right.
We'd have a current account surplus. We'd have a trade surplus.
The Federal Reserve learned central banking. They should read a book, Central Banking for Dummies. They need a new lesson.
Well, I agree with that. They help debase our money and destroy our economy.
They did debase the money.
All right. I think everybody agrees that the Fed's made some terrible mistakes and that the dollar, by the way, if we had linked the dollar to gold, as Steve was once suggesting about 15 years ago, oil would be about $30 a barrel. So
no, it would be $3.60 a barrel.
There you go. It depends when you linked it. So I think we all agree with that, Peter. But the question is, America's future, we think it's secure because it's still strong.
It's not strong. It's a facade. It's a house of cards, and it's about to cave in. You got to read my book,
Steve. We have to agree to disagree on that point.
How long has he been saying this, by the way?
I've been right.
I mean, I've been debating people saying exactly the same thing all through the 80s, all through the 90s, and now again. It's just they keep always the United States is going down the drain.
Go on YouTube. Watch my clips.
Polishing the shoes of the Japanese about now.
I've had this thing pegged from the beginning.
All right, we're gonna leave it with that, with Peter Schiff's peg. Thank you, Peter. Appreciate you coming on. George Gilder, Steve Forbes, great to see you as well.
Thank you, David.
Coming up on deck, the winners and losers of the countrywide financial deal power rankings when Scoreboard continues.